Hey everyone, welcome back to Money Mint. I'm Mr. Mint, and today we're talking about something that controls your financial life in America more than almost anything else, your credit score. Think I'm being dramatic? Let me prove it to you with some real examples. This 3-digit number can decide if you get that nice apartment you've been looking at. It decides what interest rate you pay on your car loan. It affects if you can get a credit card with good rewards. Some landlords check it. Some insurance companies check it. Even some employers check your credit before hiring you. It's everywhere in your financial life. But here's the good news. You don't need to be rich to have an excellent credit score. You don't need a high income. You just need to understand how the system works and follow a simple plan. And that's exactly what I'm going to give you in this video. By the end of this 30-minute guide, you'll know exactly how to build a 750-plus credit score from scratch, step by step. No confusing jargon, just simple, actionable advice that actually works. Let's get started. So first things first, what actually is a credit score? In simple terms, it's a number between 300 and 850 that tells lenders how likely you are to pay back money you borrow. Think of it as your financial GPA. The higher your score, the more trustworthy you look to banks and lenders. Let me break down what these numbers mean. 300 to 579 is considered poor. 580 to 669 is fair. 670 to 739 is good. 740 to 799 is very good. And 800 to 850, that's exceptional. Our goal today is to get you into that very good or exceptional range. 750 plus is absolutely achievable. Who creates this score? There are 3 main credit bureaus in America: Equifax, Experian, and TransUnion. These companies collect information about your credit history from banks, lenders, and other sources. They create your credit reports. Then companies like FICO and VantageScore use that information to calculate your actual score. Your credit report is like a report card for your financial behavior. It shows all your credit accounts, your payment history, how much you owe, and more. And just like a school report card, you want to see good grades here. A's and B's, not F's. Now, why should you really care about this? Because a good credit score saves you real money. Let me give you a concrete example. On a $30,000 car loan over 5 years, someone with a 750 score might pay around 4% interest. Someone with a 580 score might pay 15% interest or even more. That's nearly $9,000 more for the exact same car. Your credit score literally saves or costs you thousands of dollars. A good score also gives you options: better credit cards with better rewards, higher credit limits, easier approval for rentals. Your credit score is built on 5 main factors. Think of them as 5 pillars holding up your financial house. Each one has a different weight. Understanding these is absolutely key to building a great score. Let me explain each one in detail. Factor number 1 is payment history. This is the biggest one by far. It makes up 35% of your score. This simply means, do you pay your bills on time? Every single time. Lenders want to see that you're reliable and consistent. One late payment can hurt your score significantly. Let me show you why this matters so much. Imagine 2 people with identical credit profiles. Person A pays all their bills on time. Every time. Never misses a due date. Their score goes up steadily. Person B misses just 1 credit card payment by 30 days. That 1 late payment stays on their credit report for 7 years. Their score drops maybe 50 to 100 points instantly. It takes months of on-time payments to recover. That's how powerful payment history is. So rule number 1, never miss a payment. Ever. Set up autopay on all your accounts. Put reminders on your phone calendar. Do whatever it takes to pay on time. This is the foundation of a good credit score. Without good payment history, nothing else matters much. Factor number 2 is amounts owed. This makes up 30% of your score. This is also called Credit utilization. It measures how much of your available credit you're actually using. If you have a credit card with a $1,000 limit and you owe $900, your utilization is 90%. That's bad. The ideal utilization is under 30%. So on that same $1,000 card, you want to owe less than $300. Even better is under 10%, which would be under $100. This shows lenders that you're not desperate for credit. You use credit responsibly, not as a crutch. Here's a pro tip that many people don't know. Even if you pay your full balance every month, your utilization might still look high if your statement closes with a high balance. So, if you're planning to apply for new credit soon, try to pay down your balances before your statement closing date. Factor number 3 is credit age or length of credit history. This makes up 15% of your score. Simply put, older accounts are better. Lenders want to see that you've been managing credit responsibly for a long time. If you have a credit card you've had for 10 years, that helps your score a lot. If all your accounts are just 6 months old, your score might be lower. So here's a key tip. Don't close your old credit cards, even if you don't use them much. Just use them occasionally to keep them active. A small purchase every few months is enough. Factor number 4 is credit mix. This makes up 10% of your score. This looks at the different types of credit you have. Revolving credit, like credit cards. Installment loans, like auto loans. Student loans. Mortgages. A mix of different types shows you can handle various kinds of credit. Factor number 5 is new credit. This makes up the final 10%. Every time you apply for credit, the lender does something called a hard inquiry on your credit report. This can temporarily lower your score by a few points. If you apply for many credit cards in a short time, those hard inquiries add up and your score drops more. A hard inquiry happens when you apply for credit. A soft inquiry happens when you check your own score or when companies pre-approve you. Soft inquiries don't affect your score at all. One exception though, when you're shopping for a mortgage or auto loan, multiple inquiries within a short period, usually 14 to 45 days, count as one inquiry. This allows you to shop for the best rate without hurting your score. So those are the 5 factors. Payment history at 35%, amounts owed at 30%, credit age at 15%, credit mix at 10%, and new credit at 10%. Keep these in mind as we move forward. This is the foundation of everything. Now that you understand how credit scores work, let's talk about how to actually check your own score for free. Before you can build your score, you need to know where you're starting from. The official government-authorized website is annualcreditreport.com. Thanks to federal law, you're entitled to one free credit report from each bureau every single week. When you go to that website, you can download your reports from Equifax, Experian, and TransUnion. Review them carefully. Make sure all the information is correct. Look for accounts you don't recognize. Look for payments that are incorrectly marked as late. These errors happen more often than you might think. For your actual credit score, not just the report, you can use free services like Credit Karma, Credit Sesame, or these give you Vantage scores for free. They're not exactly the FICO scores that most lenders use, but they're close enough to track your progress month to month. FICO scores are used by 90% of lenders. Vantage scores are what you get on free apps. They're different, but usually move in the same direction. Many credit card companies also give you free FICO scores now. Check your Chase app, your Discover app, your Capital One app. You might already have access to your score and not even know it. A quick warning, the score you see on Credit Karma might be a little different from what a lender sees. Lenders often use different versions of FICO, but the direction is what matters. If your Credit Karma score is going up, your real score is probably going up too. So step 1. Check your current credit. If you haven't done this in a while, do it today. Know your starting point. Now, let's get to the really good stuff. How do you actually build credit if you're starting from absolute zero? Maybe you're young and just turned 18. Maybe you're new to the country. Here's your complete step-by-step plan. Step 1. Get a secured credit card. This is different from a regular credit card. With a secured card, you give the bank a deposit upfront, say $200 or $500. That becomes your credit limit. You use the card, make purchases, and pay them off each month. The deposit protects the bank if you don't pay. It's like training wheels for your credit journey after 6 to 12 months of responsible use. Most secured cards will graduate you to an unsecured card and return your deposit to you. Some great options to look at are Discovered It Secured and Capital One Platinum Secured. They're widely available and have good terms. Step 2. Become an authorized user on someone else's account. Find a family member or trusted friend with good credit. Ask them to add you as an authorized user on their credit card. Here's the magic part. You don't even need to use the card. Their good payment history gets added to your credit report automatically. This can give your score a huge boost right away. Step 3. Consider a credit builder loan. Some credit unions and online lenders offer special loans designed specifically to build credit. You make payments for 12 months, then get the money back at the end. Step 4. If you have student loans, those already help you. Federal and private student loans show up on your credit report. As long as you make payments on time, they build your credit history. After about 6 months of this, you might qualify for a regular unsecured credit card. Start with just one card, use it for small purchases, and pay it off in full every month. But I need to give you a warning. Building credit takes time and discipline. Don't apply for too many cards at once. Don't spend money you don't have. The goal is to build a strong history, not to get into debt. Remember, credit cards aren't free money. They're tools. Use them wisely. Pay your balance in full every month if you can. If you can't, at least pay more than the minimum. So that's your starter plan. Secured card, authorized user, maybe a credit builder loan. Do this consistently, and you'll have a solid score within a year. You can do this. Thousands of people have built their credit from nothing. You're next. Just follow these steps and be patient. Your future self will thank you. Now, what if you already have credit, but it's not good? Maybe you made some mistakes in the past. Late payments, collections, high balances. Don't worry, you can fix this. It takes time, but it's possible. Step 1. Get your credit reports from annualcreditreport.com. Go through every single line item. Look for errors, wrong addresses, accounts you never opened, payments marked late that were actually on time. The Federal Trade Commission did a study and found that 1 in 5 people had an error on at least one of their credit reports. So don't assume everything is correct. Step 2. Dispute any errors you find. You can do this online with each credit bureau's website. They're required by law to investigate within 30 days. If the information can't be verified, they have to remove it from your report. This can boost your score quickly and sometimes significantly. Step 3. Bring all your current accounts up to date. If you have late payments, the most important thing is to never miss another one going forward. Set up autopay for at least the minimum payment on every account. On-time payments are the fastest way to rebuild your score. Step 4. Pay down your credit card balances. High credit utilization is one of the biggest drags on a credit score. Focus on paying off credit cards first. Step 5. Be patient with negative items. Late payments stay on your report for 7 years. Bankruptcies for 10 years, but their impact lessens over time. If you have accounts in collections, you might try what's called pay. That's when you offer to pay if they agree to remove the collection from your report. Not all companies agree, but it's worth asking. Be careful of credit repair companies that promise to fix your credit overnight. Most are scams. You can do everything they do for free by yourself. Remember, credit repair takes time. There are no quick fixes, but with consistent effort, you can see real improvement in 6 to 12 months. Stick with it. You'll get there. Before we wrap up, let's clear up some common myths about credit scores. These misconceptions can actually hurt your progress. So let's separate fact from fiction. Myth number 1, checking your own credit lowers your score. This is completely false. When you check your own credit, it's a soft inquiry. It doesn't affect your score at all. Check as often as you want. Myth number 2. You need to carry a balance to build credit. Also false. Carrying a balance just means you pay interest. You build credit just fine by paying your full balance every month. That's actually the best way. Myth number 3. Closing credit cards helps your score. This is usually false. Closing a card hurts your credit utilization and your credit age. Unless the card has an annual fee, keep it open. Myth number 4. Your income affects your credit score. False. Your income doesn't appear on your credit report at all. Lenders might ask about it, but it's not part of the score calculation. Myth number 5. Married couples share credit scores. Also false. You and your spouse have completely separate credit reports and scores. Any joint accounts appear on both, but your scores are individual. So now you know the truth. Don't let these myths hold you back. Check your score freely. Pay in full. Keep old accounts open. You're now armed with the right knowledge. Let's wrap this up. Let's take a few minutes to recap everything we've covered. Your credit score is a number from 300 to 850 that lenders use to judge your reliability. It affects your interest rates, your loan approvals, and even your ability to rent apartments. It's based on 5 factors. Payment history is 35%. Always pay on time. Amounts owed is 30%. Keep your credit utilization under 30%. Credit age is 15%. Keep old accounts open. Credit mix is 10%. Have different types of credit. New credit is 10%. Don't apply too often. To build credit from scratch, start with a secured card, become an authorized user, and consider a credit builder loan. Pay everything on time. Keep your balances low. Be patient. To fix bad credit, check your reports for errors. Dispute what's wrong. Pay down balances. And never miss another payment. Remember the myths. Checking your own score doesn't hurt it. You don't need to carry a balance. Keep old accounts open. Your income doesn't matter. And married couples have separate scores. You've got this. Building a 750 plus credit score is totally achievable. Start today. Check your credit. Make a plan. Take that first small step. If this video helped you, please hit that like button. Subscribe to Money Mint for more simple money tips. Next time, we're talking about Roth IRA versus 401k. Which one is better for you? Don't miss it. I'm Mr. Mint, and I'll see you in the next video. Remember, your future self will thank you for the work you're doing today. Take care of your credit, and your credit will take care of you. Thanks for watching.